You're listening to AI Signals Daily Dose.
$650 billion. That's what the four biggest tech companies on the planet are planning to spend on AI infrastructure this year. Not over a decade, not as a long-term projection. This year. To put that in perspective, that's more than the entire GDP of Sweden. And the wildest part, even that might not be enough. Google's CEO says he still can't get enough compute.
This is your daily dose for Sunday, February 9th, 2026. Today, we're doing a deep dive on the single biggest corporate investment in history. We're breaking down who's spending what, why they think it's worth it, and whether this is the smartest bet ever made or the beginning of the most expensive bubble the world has ever seen. Let's get into it. All right, let's start with the numbers, because the numbers are genuinely staggering. Amazon leads the pack. $200 billion in capex for 2026. That's not a typo. $200 billion. Morgan Stanley analysts now project Amazon will have negative free cash flow of almost $17 billion this year. Bank of America thinks the deficit could hit $28 billion. Amazon is literally spending more than it makes to build AI infrastructure. Next up, Alphabet. Google's parent company announced capex guidance of $175 to $185 billion. Wall Street was expecting around $119 billion. Deutsche Bank analysts said Alphabet, and I'm quoting here, stunned the world. The stock dropped 7% the morning after earnings, despite actually beating on both revenue and profit. Earnings per share came in at $2.82 versus an estimate of $2.63. Revenue hit $113.8 billion, up almost 18% year over year. The results were great, but investors couldn't see past the spending. Microsoft is on pace for about $145 billion in annual capex based on its current fiscal year run rate. And Meta announced plans to spend between $115 billion and $135 billion, driven by its Meta Superintelligence Labs and core business investments. Barclays analysts now project Meta's free cash flow will drop by almost 90%. Let that sink in. 90%. And they're modeling negative free cash flow for 2027 and 2028, which Barclays themselves called, and again, I'm quoting, somewhat shocking. Add it all up, and the four hyperscalers are approaching $700 billion in combined capex for 2026. That's roughly a 60% increase from a year earlier. Bloomberg called it a level of corporate investment that has few modern parallels. About 75% of that spend, roughly $450 billion, is going directly to AI infrastructure, servers, GPUs, data centers, networking equipment, the physical backbone of the AI era. So that's what's happening. Now let's talk about why. Because these aren't reckless companies. They're making a calculated bet that the demand for AI compute is going to be so enormous that anyone who doesn't invest now will be left behind. And there's real evidence backing them up. Google Cloud revenue surged 48% last quarter to $17.7 billion. Gemini, Google's flagship AI app, now has 750 million monthly active users, up from 650 million the previous quarter. That's 100 million new users in 3 months. CEO Sundar Pichai said on the earnings call that compute constraints keep him up at night. Even with $185 billion in planned spending, he expects Google to remain supply constrained throughout the year. Goldman Sachs published a report arguing that AI companies may need to invest more than $500 billion in 2026 just to keep up with demand. The thesis is straightforward. AI is a generational technology shift. The companies that own the infrastructure will control the platform, and if you wait to see if demand materializes, you'll be 2 years behind and unable to catch up. This is the logic behind every great infrastructure build out in history, from railroads to fiber optics. Build it before the demand fully arrives, and you own the future. There's also a competitive dynamic at play. None of these companies can afford to be the one that blinks. If Google scales back and Amazon doesn't, Google risks losing cloud customers permanently. If Meta pauses and Microsoft pushes ahead, Meta falls behind on model training. The spending has become a prisoner's dilemma. Every company would prefer to spend less, but no one dares to be the first to slow down. Now, here's the question that everyone in finance is asking. Is this the smartest investment cycle in history? Or are we watching the early stages of a $2.5 trillion bubble? The skeptics have real ammunition. An August 2025 report from MIT's Media Lab found that despite $30 to $40 billion in enterprise investment into generative AI, 95% of organizations are getting zero return, not low return, zero. Forrester has predicted an AI market correction in 2026, citing a widening gap between vendor promises and actual value delivered. Fewer than 1/3 of decision makers can tie AI spending to their organization's financial growth. And then there's OpenAI, the company that arguably started this whole gold rush. In November 2025, OpenAI said it expects to report annual losses through 2028, including $74 billion in operating losses in 2028 alone. Deutsche Bank estimated OpenAI's total losses between 2024 and 2029 at $140 billion. The most prominent AI company in the world doesn't expect to turn a profit for years. Meanwhile, the market concentration is getting uncomfortable. In late 2025, 30% of the S&P 500 and 20% of the MSCI World Index was held up by just 5 companies. That's the greatest concentration in half a century. Share valuations were the most stretched since the dot-com bubble. But here's the counter argument, and I think it's worth sitting with. The dot-com bubble was driven by companies with no revenue and no product. These companies have massive revenue, growing demand, and real customers paying real money for AI compute. The question isn't whether AI creates value. It clearly does. The question is whether this specific level of spending will generate proportional returns, or whether we're overbuilding by a factor of 2 or 3. Some analysts think the truth is somewhere in between. AI is both a genuine technological supercycle and a capital allocation bubble at the margins. Both of those things can be true at the same time. Not every dollar being spent will generate returns. Some of these data centers will be underutilized. Some of these models will be obsolete before they finish training. But the underlying technology is real. The demand curve is steep, and the companies making these bets have the balance sheets to survive, even if the payoff takes longer than expected. What seems more likely than a dramatic crash is a correction, where companies narrow their focus to use cases with proven ROI, experimental spending drops, and the market rewards execution over ambition. So, what's the takeaway? We're living through the largest corporate investment bet in history. $650 billion this year alone, concentrated in 4 companies, aimed at a technology that's transforming how every industry operates. The bulls see a generational opportunity. The bears see a generational risk. And the honest answer is that nobody, not the CEOs spending the money, not the analysts modeling the returns, not the investors buying or selling the stock, nobody knows for sure how this plays out. What we do know is this: the decisions being made right now, this quarter, this year, will shape the technology landscape for the next 20 years. Whether it's the best investment ever made or the most expensive lesson ever learned, we're going to find out together. I'll be back tomorrow with your next dose. Until then, stay curious.